I want to bring in our next guest, who predicts that the Fed will be abolished one day. He probably wishes that that meeting had never taken place 100 years ago. Joining us this morning with more of his opinions is Fleckenstein Capital president and founder Bill Fleckenstein. So, Bill, you know, these guys are down in Georgia. They must be second-guessing what they did, though, on Wednesday. And you are probably disgusted with what happened.
Well, first of all, I didn't say the Fed will be abolished. I said I think that, you know, they'll be taken out of the business of the let's guess the right interest rate to run the world game. I mean, there's a need for the Fed to do what it was originally set up to do, which was to provide liquidity to the banking system. But you don't. But
you don't want the Fed around, though, right? Is that right? Am I right or wrong about that?
Well, not in its present. We have a group of men who in old Politburo fashion sit around in a room and they try to guess what interest rate is the right one to run the world. Gee, in less 15 years, we had an equity bubble that burst that caused a tremendous amount of damage. In response to that, they took rates too low, held them there too long, allowed a real estate bubble to fester, which nearly wiped out in the end the banking system and most people in America. And now we're going to try to print our way to prosperity because the Fed has decided the inflation rate is too low. The Fed's mandate regarding inflation was it wasn't supposed to get too high. And so now these idiots think we can print our way to prosperity. It is simply not possible, or there would never have been any currency train wrecks in any third world country.
But fair enough. I understand your point about inflation. I agree with you on inflation. But what I was saying is that all this talk about QE2 has suddenly turned our sentiment from double-dip recession back in August to now we're not even talking about that anymore.
Well, and the point I was making to you is you can put together a policy that in the short run is palliative to the markets and makes people feel better, but might be a very bad policy in the long run. And the reason I was talking about the housing bubble is because a lot of people thought everything was just wonderful when the housing bubble was raging, and I kept making the point it was going to end in disaster, which it did. Right. And this policy of printing money will also end in disaster. It'll just be a different kind of a disaster. So in the short run, stocks can rally, and they might rally a bunch more. I'm not saying they won't. We're printing money, and that's usually what happens. I'm just saying this is not good policy. It won't end well, and so that's my point.
Right. It'll end badly for all. It'll end badly for all of us, ending in hyperinflation. Yes. Right, Bill?
No, I'm not saying hyperinflation.
Okay, what are you saying?
There's a big step between. The Fed's going to get more inflation than it bargains for, and we got to remember the CPI is useless as a barometer of inflation. Between hedonics and substitution, I had a chapter on this in the book I wrote about the Fed. You were not going to get any CPI inflation, but that doesn't mean inflation isn't already a problem.
Okay, Barton, I want to get you in on this.
I'm here.
Okay, I want to get your take on what Bill is saying, which is essentially that this is all going to end in disaster with what the Fed's done.
Well, with great respect to Bill, I'll just say, what would he have done if he was chairman of the Fed? And I think that what Bernanke did was absolutely right. And we still are in a very precarious situation where the economy could easily tip back into a double dip, and Bernanke did what he had to do, which was to get asset prices up, create some inflation, and avoid the risk of a double dip of deflation.
Right.
And so, look, he may be absolutely right that we're going to have a disaster later on. But
the Fed's job is not to generate growth. The Fed's job is to control inflation and deal with unemployment. And buying more bonds is not going to create more jobs any more than QE1 created any jobs. So they can print money if they want to, but this step is totally unnecessary.
But Bill, okay, again, you're saying what you wouldn't have done, but what would you have done then? And I understand, you know, the whole what would you have done?
I said in the financial crisis, what they did is acceptable, okay? But this QE2 is totally unnecessary. There's no reason to do it. It's going to cost us more in the long run than the benefits you're going to get from it.
Barton?
Oh, I just totally disagree. I mean, the U.S. economy is not, and the global economy are not healthy. They're still in the recovery ward, and we're tipping along the cliff edge with deflation on one side, and the very, very important price is the price for existing single-family homes, and it's soft and weak, and so he really had to do what he's doing, and he's gotten the stock market up, which is what he wants to do. The stock market is an important symbol of confidence, and Mr. Market's a pretty good forecaster of the economy.
Okay,
and he's gotten them up. So that's what he wants to accomplish.
When Mr. Market was reveling in the equity bubble and the real estate bubble, he didn't see any of the problems coming. Easy money gets markets up, but easy money doesn't necessarily solve the problems.
Right.
Easy money is not going to fix the housing price bubble because prices.
Right. It's telling you that we had the German finance minister Schäuble coming out saying that the U.S. QE2 is, quote, clueless. Very strong words coming out from him saying that essentially that the U.S. is doing what China has been reproached for, which is essentially managing their economy. Remember that this came after the Brazilian finance minister said that Bernanke is basically throwing money out of a helicopter, and that the Chinese also came out and said that this is essentially an indirect manipulation of the exchange rate. These are all coming out from other finance ministers around the world. And Barton, I want to get you to respond to that because, you know, these are really strong words coming, strong criticisms coming out on the Fed.
Well, the Germans, both the finance minister and the president of the Bundesbank have been very outspoken in saying that the ECB should not intervene in the sovereign debt markets and so on. And Frank, they're a bunch of grouches, and they've got they don't have the same problems that we have. And Bernanke, after all, is an American, and he's concerned about the American economy, and he's concerned not only about inflation but also about employment, and that's what his mandate is. And we are where we are, and it's fine to say they shouldn't have done things in the past, but we are where we are now, and he's doing the right thing. He's trying to get us out of this, out of the normal deflationary death spiral that would follow a big financial panic.
Right, and that's true. However, I can imagine why these leaders are saying this. These finance ministers, they may be grouches, but they're saying it because they're worried about an emerging markets bubble coming up, right?
Well, I guess they're worried about an emerging markets bubble, but we're not. We probably are going to have emerging markets bubble in the future, and we probably are going to have a bigger bubble because of what Bernanke has done. It's not my job to try and to correct the past. I'm just saying what he's done is the right thing now, and it's fueling a liquidity, and I think we're going to have higher stock prices for a while. But how it's all going to play out in the long run, I don't know. And maybe Bill's right. Maybe it's going to lead to a hyperinflation bust at some point. But that could be a couple of years from now, and that's not the way our investors look at us. They're valuing us on how we do in the next couple of months and the next couple of quarters.
Well, and Bill, I mean, I imagine that's exactly what gets us into this trouble, though.
No, no. I mean, but I want to be clear. I don't think it's going to end in. This is all going to end in hyperinflation, and I think the European banking system had some of the same problems ours did. And the big difference between Europe right now and us is that we have a printing press. We're willing to use it, and they don't. In the short run, and Barton's right. Stocks are probably going to go up, and I'm not here to say that they're not. But my point is that the reason I'm talking about this QE not being necessary is because I believe that the belief in printing money can help us is kind of what created some of the other problems. And I think doing this might help us in the short run, but in the longer run we'll be worse off. As speculators, we can figure out what to do. I've thought the Fed's pursued bad policy for a decade. I've been able to make money as a consequence, but I don't think it's the right thing for my kids and their kids. So that's the distinction I'm trying to make.
Okay, so I'm hearing some more agreement then, at least as I end this. Then I've got to, we only have a certain amount of time here on television. But in any case, I appreciate both of you joining me for this debate. Barton Biggs with us, as well as Bill Fleckenstein. Hope to have you guys on again soon.